All right, welcome back. In our last analysis, you guys completely mastered the absolute foundation of the bond market, that inverse relationship between interest rates and bond prices. So today, we're going to take that mechanical rule and actually apply it to read what I like to call the ultimate macroeconomic weather forecast. We're talking about the yield curve. It's basically a single chart tracked by literally every professional trader out there because it has preceded almost every single US recession in the last 60 years. We'll break down the four specific shapes this curve can take, what each one is screaming about the economy ahead, and exactly how you can read it to protect your own portfolio.
But first, a really quick rapid-fire recap. Remember the rule. Rates go up, bond prices go down. Always. It's a strict inverse relationship. Think of it like a seesaw. When the Federal Reserve raises rates, newly issued bonds start paying more, right? Which immediately forces the resale price of older, lower-yielding bonds down. And, conversely, when rates are cut, those older, higher-yielding bonds instantly become way more valuable. So keep this seesaw mechanic in the back of your mind as we move forward, because it's the fundamental engine driving every single curve shape we're about to explore.
Okay, so here are the four macro weather patterns we can expect to see over time. Let's walk through them. First up, we've got the normal curve. It slopes nicely upward, and this is your healthy default state. It signals an expanding economy and a bullish trend, usually happening when the Fed just holds rates steady. Second is the steep curve. This one shoots sharply upward. We typically see this right after a recession ends. It's signaling increased capital demand and the start of a major new bull market, mostly because short-term rates stay low while long-term growth expectations really start to improve. Then, things get a little tricky with the flat curve. Here, short and long-term yields are roughly the same. This one signals slowing economic growth. It's like a transition zone with a really high probability of trouble ahead. And finally, we hit the rarest and absolutely most alarming shape, the inverted curve, where the line actually dips downward.
Now, I want to zoom in on that inverted curve for a second, because this is the one shape you literally never wanted to ignore. By definition, an inversion happens when short-term interest rates sit absolutely higher than long-term rates. And honestly, this is considered one of the most reliable single recession signals we have available to us. But here's the really key takeaway. While it is an urgent alarm, it's not a stopwatch with a fixed countdown. Historically speaking, the lag between a curve inversion and an actual official recession can range anywhere from 6 to 24 months. So it's more like a flashing warning light telling you trouble is on the horizon. It gives you the critical lead time you need to play defense with your investments.
So why does this rare inversion actually happen in the first place? Well, it's basically a massive financial tug-of-war. An inversion is the result of two intensely bearish forces pulling at the market at exactly the same time. On one side, we have Force 1, the Federal Reserve aggressively raising short-term rates to fight inflation. They're artificially pushing the short end of the curve up. On the other side, we have Force 2, bond market investors. Their long-term growth expectations have completely collapsed. They sense a recession coming, so they just rush in a flight to quality. They lock up long-term bonds for safety. And that massive buying demand, it pushes long-term yields down. So when these two giant forces crash into each other, the Fed pushing short rates up, panicked investors pushing long rates down, they cross in the middle. And boom, you've got an inversion.
To see how this translates from theory to reality, let's just look at a recent timeline. Back in mid-2022, the highly watched 2-year and 10-year Treasury spread completely inverted. The Fed was aggressively hiking their benchmark rate from near zero to over 5% just to fight rampant inflation. Meanwhile, investors were seeing the writing on the wall and completely fleeing to safety. Throughout 2023, the curve stayed inverted for an unusually long stretch, actually the longest stretch in decades. This specific signal completely dominated Wall Street financial headlines, and it fed directly into nonstop recession timing debates for the next 2 years.
All right, let's put your new knowledge to the test. Imagine this scenario. The 2-year yield just moved above the 10-year yield. Take a second and think about what that actually means on a chart. What shape is this? And more importantly, how urgent is this signal compared to a curve that is merely flat? Try to think back to that massive tug-of-war we just talked about.
And here's the reveal. If the 2-year is yielding more than the 10-year, you are looking squarely at an inverted curve. Short is greater than long. And here's what most beginners get completely wrong. They just assume a flat curve and an inverted curve mean the exact same thing. They absolutely do not. An inverted curve is an urgent, highly reliable recession warning. It is the most severe of the four shapes, hands down. By contrast, a flat curve, where short yields roughly equal long yields, well, that certainly signals slowing growth and a transition, but it's not an outright recession call just yet. So don't confuse the two. Urgency really matters when you're managing risk.
So let's wrap up everything we've covered today.
You now possess a complete toolkit for reading this part of the macro weather. You know the foundational inverse rule between interest rates and bond prices. You can easily identify all four curve shapes: normal, steep, flat, and inverted. Plus, you totally understand the intense tug-of-war mechanics that actually cause that alarming inversion to happen in the real world. So here's your action step for today. As soon as we finish up here, go online, look up today's 2-year versus 10-year Treasury spread, and see if you can correctly classify which of the four shapes it currently represents. You can now literally read the bond market's crystal ball for yourself.
Now that you know how to read the macro weather, and we're talking the business cycle, sector rotation, and now the yield curve, it is time to turn that forecast into actionable stock picking. In our next explainer, we're going to dive into a legendary, old-school philosophical fight: value versus growth, buying low versus buying high. Both approaches have made fortunes, but here is the ultimate question for you to chew on. If the yield curve inverts tomorrow, is your current portfolio prepared to survive, or are you holding the exact wrong stocks for a storm? Until then, keep analyzing those curves, and I'll see you in the next explainer.